Hello everyone, welcome back to the channel. Hope you've been doing well. Today we've got our usual bi-weekly portfolio update, and I'm actually very excited to talk to you about it. And it might be very odd considering how the market is doing and how the portfolio is doing, as you can see why I might be excited to talk to you about it. But I think that today's episode is going to be a very important lesson to investing. And it should be a very important lesson to everyone out there who wants to get into investing, that this is what they're going to experience when they go on this journey. As you can see here in the chart, we had a really good run at the beginning of the year. We were up to getting close to almost 100 actually. We were probably a couple $1,000s away. And since the last portfolio update to now, we've had a significant correction in the portfolio value. Now that actually is more true for the US. The Canadian one, since it was already a little bit choppy anyways, you can see it's been a little bit up and down. And it's also come down since the last portfolio update, but it's much more mild compared to what you saw in the US one. Now, if we get to the actual numbers, you can take a look here as to what the actual numbers are looking at. From the last couple of weeks till now, we're down roughly $11,500. The Canadian one, much more mild, down about $700. Now, if you watched my last video that I put out about a week ago, you can see how we were outlining the main reason for this valuation reset or stock market volatility was due to interest rates. If you haven't watched it, I do highly recommend you go see it, as I go in much more in depth as to why interest rates might be the culprit for the recent stock market volatility. But the long and short of it is that basically when interest rates go up, risk-adjusted returns definitely come down, and as a result, you get a valuation reset. And the stocks that get hit the hardest are always the growth-focused stocks. These are the ones that run up the highest and the quickest when things are going well, and when it flips, they're always the ones that come crashing down first. Now, as I was mentioning earlier, I believe that this episode will be a pretty important lesson because you can now clearly see and try and experience and put yourself in the shoes of what you would do if this was your money. If you were working along during your workday and maybe you flip open your phone during break time and you see that the markets are down a lot, or at least your portfolio is down a lot. You know, during the last couple of weeks, my portfolio was down at least on the worst day. I think when I checked it at one point, it was down $5,000 or $6,000 in one day. And so when you see that, can you picture yourself holding through the volatility, or perhaps even adding during this volatility? Because if you're really believing in the long-term outlook of these companies, that is exactly what you should be doing, right? If you can buy this, if you think this company is going to be 2x, 3x, 5x down the road, because you think it'll be a major player in the field, or you think they're going to be revolutionizing the industry, and it drops 10, 15, 20%, or in some of these stocks that we'll go over later, maybe 40 or 50% from the highs, that represents a significant discount. And if you thought it was going to 5x before, well, now it's going to 10x based on your original projection, right? We are investing in companies. We are not investing in the market. If we're researching a company based on what we think it will do in 5, 10 years, what the market does today doesn't matter. If there's a valuation reset and it drops by 30% or 40%, that is better for us, right? Because nothing has changed in the research between then and now. If the market drops it by 30%, your research and your belief in the company should not change if you've been doing your research properly. So I think charts like this are kind of important, right? And if you've been following along week after week, really do try and put yourself in the shoes here of what you would do when you see a steep decline like this. Do you have that resiliency to hold to the strategy? And do you have that resiliency to maybe even add into the portfolio while it's down? Because if you don't, it doesn't mean that you're not cut out for investing, but maybe what you should be doing is perhaps getting into a less growth-focused style of investing. Perhaps you might want to take a look at something like a balanced fund, a fund where it's 60% equities and 40% fixed income. that over the last couple weeks has really not moved much. I believe it's down a couple points, but nothing as drastic as, you know, kind of the 10 to 12 points that my portfolio. So let's take a little bit of a more in-depth look at the portfolio now. I think it was last video or maybe 2 videos ago, I talked about what I would do if there was a market correction. And if you look at the big indexes, there actually hasn't been a correction, so to speak, as a whole. What's happened is you've actually seen a cycle where people have been cycling their funds from high growth investments or more growth focused stocks to more of the value investment stocks. So you're talking about energy and financials mostly. Energy, I believe, is up around 35%, and energy means stuff like oil, gas, those types of stocks, and financials are more of your banking stocks. So in this portfolio and the type of investing that I do, because I have such a long-term outlook on it, I don't really have those types of stocks in this portfolio. The stocks that I have in this portfolio are much more geared towards long-term investing, similar to what Cathie Wood talks about when she talks about ARK investing. She's very much about stocks that can be disruptors in their industry and that can revolutionize the industry, and whether it's their own industry or even creating a new industry themselves. You know, those are the stocks that she focuses on. I like that type of investing because I think that for such a long time horizon, that is the way to go. And realistically, because the market is always a forward-looking market, meaning the market really cares about what is going to be happening 5 years, or maybe not that long. The market probably is more like 3 to 6 months to a year down the road. That's really what the market is focused on. Being able to get ahead of it will or should produce the best long-term returns if you pick correctly, right? There was a time when all these lovely unrealized gains to the right were actually all in the black, which was when the portfolio was up quite a lot. But now you can see a lot of these are actually in the red now, which means I'm actually down in the negative. And there actually has been a bit of restructuring, quote unquote, done, so to speak, because one of the strategies that we talked about in that other video during a correction is you sell the stocks, or at least the strategy that I would employ is that you sell the stocks that maybe you have less conviction in, or maybe that you had bought more recently, because during a correction, if you had bought them more recently, then due to the market going on a downturn, now you've got unrealized losses, right? So if you're able to then sell those stocks, move them into your most high conviction holdings, then that creates a tax loss during the year. And that's more of a tax optimization strategy than anything else. But it gives you also a great opportunity to then buy the stocks that you love the most at the discount during the reset. So now we've got a couple companies, or a lot of companies, about maybe half of the portfolio-ish in the red. Overall, we're still up. That goes for the coin flip as well. The coin flip is up as a whole, but I did sell out of one of the coin flip companies. On the Canadian side, it's actually down as a whole, and that's mostly because I had initiated a beginner's position in Shopify. And Shopify is a company that I will definitely be investing in long term. Turns out I bought probably pretty close to the peak. The peak was about $1,900. I think it might have touched 2,000 at one point, but I'm not sure. And now we're down about 20-30% since then. So I'm not fazed by it. For a lot of this portfolio, what I will be doing is like you see with Pakar and Zora back in the other coin flip portfolio, these are ones that I have less conviction in, and what I'll be doing is I'll be putting them more into my more conviction companies. So Teladoc is one that I added to. Taiwan Semiconductor is definitely one I'll be adding to. I've already got a pretty good weight in terms of the market value on Apple, Microsoft, MasterCard, and Visa. Those are kind of my blue chip stocks that I think will be good long-term holdings. They're not going to be the most growth-oriented stocks, but I think that they will continue to do well as they also push towards the future. And the perfect example of people starting to move funds out of growth investing into more value investing, to me, is a stock like Zoom. If we pull up Zoom, they just actually had their earnings recently. They had their earnings on March 1st. Actually, before we get to the earnings, let's take a look at the Zoom as a company, or at least the stock price recently. Over the past year during the pandemic, it was a company that was down in the low, let's say 60s, 70s, 80s. It kind of traded around that range. And if we take a look at the 1-year chart from today, a year ago it was around $114. During the height of the pandemic, it soared to as high as $568. And since then, it's had the most volatile performance with significant upswings and downswings, but mostly downswings. And now it's trading at about $337. So that's roughly about 40%, 35% off its all-time highs. And you might think, oh, well, is Zoom performing 35% worse than it was in October? Well, actually, no. Zoom is continuing to grow at a monstrous rate. That's kind of where the earnings come into play. But what the market seems to be doing is, because of the rise in interest rates, they seem to be factoring a significant discount when it comes to growth-oriented stocks, which is normal because, as I talked about, for risk-adjusted returns, when interest rates are going up, stocks that are considered more risky, they will be trading at a lower multiple. So now you've got a lot of the growth-focused stocks that might have been trading at a 40-50 multiple before. Now maybe they're down trading at 20-30 times sales, which is actually, fairly respectable and fairly common. So to me, I think that the market as a whole is more about just a value reset for a lot of the growth-focused companies. I don't believe it's any sign of a bubble bursting by any means, because you're still seeing funds shifting towards more value investments, and the market as a whole has actually not been performing poorly. It's mostly been the NASDAQ, which is focused on tech-focused companies, and the tech-focused companies, of course, have the ones that have been growing the most since the pandemic. If we take a look at the Dow Jones this past month, granted, you can see little, bit of a crazy dip there, but overall, it's actually been pretty steady. If you consider what the price is today, 31,500 from its all-time high recently, 31,900. I mean, that's a 1 or 2% difference, right? So the Dow's been down about 1 or 2% since then. This significant dip is COVID, so we don't need to worry about that. So the Dow has actually been pretty flat. The S&P 500, if we take a look at the most recent month, or the last couple months, it's at 38.41 right now. All-time high was about 39.34, so it's down about 90 points. So that's, once again, another few percent. You're looking at 3 or 4% off its highs. The NASDAQ, this is kind of where a lot of the reset happened, right? A lot of the growth stocks, as we mentioned, are one of the more, growth focused for the future. And that's where the valuation reset has happened. 12,920 off from 14,000, right? So you're looking at almost a 10% drop there. But even that doesn't really fully tell the whole story, because the big tech stocks haven't moved that much. If we take a look at Microsoft is a company, look, $244.99 from its high a little while back to $233. Like I said, that's 5, 6, 7% difference. Where you're really seeing the big differences are the growth companies. If we go back to Zoom, obviously I showed you That is a big difference from just a little while ago, $444 down to $337. That's $100 difference. It's a 30% correction. We take a look at Teladoc, another growth-focused company that I really like. $292. Now it's at $189.69. And you can go on, right? Appian, another growth-focused stock. Take a look. Just recently, $235. Now we're down at $145. So when it comes to big corrections like this and valuation resets like this, once again, it goes back to the research that you've been doing on these companies. That hasn't changed. If we take a look at Zoom earnings, it beat expectations and it issued strong guidance. Meaning when a company issues guidance, it's telling the market what it believes it will do for this year. And originally, it actually rose 11% in trading. But what happened was, as soon as markets opened, and this is on March 1st, you saw a sell-off. So if you go to March 1st, March 1st is here, 409.66 March 1st, and since then Zoom has completely sold off, right? This is once again an indication of people pulling their money out of growth-focused investments and putting them more into the value investments, the Costcos, the Walmarts, the financials, the JP Morgans, Wells Fargos, those types of companies. And there's nothing wrong with that. But that at least indicates to me that this isn't really a bubble and a pop of a bubble. And this is talking about the market as a whole. This is more just a valuation reset for certain sectors. And to me, since I believe in these companies long term, what that'll mean is I'll be pouring more money into these types of investments. Very likely you'll see over the next little while, I'll be pouring money into Pinterest, the Zooms, the Appians, these types of companies that have now come down from 30-40% from their all-time highs. To me, these are now fantastic discounts, and I'm happy that they are down this much. So overall, hopefully you can take a look at portfolios like these and the market volatility that we're all going through in real time. And that's part of why I do these videos, so that you can see them in real time to see how you would react and see if it's a fit for you. I've said before in a couple of different other videos that I don't think that you should be making stock picking your retirement strategy. For me, I have my index fund still, I have my mutual fund still, and I have a bulk of my investments in those types of strategies for my retirement because I know long term they've been proven to work. This is a portfolio that I create because, one, I really enjoy it, right? I enjoy picking stocks. I enjoy looking into the research. And obviously, I enjoy it immensely when the performance is fantastic. But this is not my full retirement strategy. Retirement is a very complicated process. It's multi-pronged attack. And I believe that for me, this strategy here with my growth-focused style investing will be a part of that. But it's not the end-all be-all. If this portfolio goes to zero, I'm not going to be homeless on the streets with no money for food, right? You should always invest what you can afford to lose. With the index investments, it's a little bit different because you're broadening your risk out a lot more. So if one company that you pick, maybe you don't do the research right. Maybe you thought it would do X and it ended up doing Y. And as a result, the market or the stock that you had plummets by 50%, right? So in a broad index type of investing or a mutual fund type of investing, you don't really have to worry about that too much. You just look at the market as a whole and you trust that in the long term, due to inflation and other factors, that the market will go up. Well, I hope you guys enjoyed the video. Thanks for watching. And please comment, like, or subscribe, and share with your friends. I'll catch you next time.